There are a number of specific legal duties, so let me comment on those briefly. One of them, and I would say the number one legal duty, is to get the best management we can. I mentioned in the introduction there's a couple books that I've put out that the ICBA is gracious enough to sell for me. One of them is Commandments for Community Bank Directors. One of those commandments is hire the best management you can and don't begrudge a well-paid management team. They're your best insurance. So get the best group you can. Second is establish appropriate policies and procedures. Now that doesn't mean the board writes them. Hopefully the board reads them, but the board needs some assurance that we have appropriate policies. If your policies are criticized by the regulators or some outside force, then we need to adjust those policies to make sure that they make sense for the bank. That's our job. The third one would be advise management, but don't micromanage. I've always told boards that if you feel like you have to micromanage, in fact, there's a former consultant now deceased who was a good friend who used to say, noses in, fingers out. In other words, don't micromanage. If you feel like you have to micromanage, that tells me you don't have confidence in your management and you need to stop micromanaging and get you some management that you do have confidence in. Develop business. One of the things the directors don't like to hear is that they have an obligation to refer or develop business for the bank, but in fact they do. One reason you're on that board is because of your connections in the community, because you're active in your trade or business, because you can refer people to the bank for loan and deposit business. Some of the new banks that I've been involved with have gone so far as to set up director expectations, some of those expectations being financial. In other words, if you don't bring whatever the number is, $2 million in deposits and loan business to the bank, you don't stand for election next year. So we need to develop business and realize that. The board also has the obligation to engage in strategic planning. This is not a budgeting exercise. This is an actual long-term planning exercise, and the board should do two parts of strategic planning. Number one, when they get together for a day or so, and if anybody wants any information on strategic planning, by the way, I do facilitate about 50 meetings a year, and I'll be happy to email that to you. Just email me at jgarish@garish.com. But when the board gets together for planning, as I mentioned, it's not a budgeting exercise. It's a 30,000-foot flyover as to how we allocate financial and managerial capital to enhance the value for our shareholders. And we need to deal with specific issues on that. So it should normally be big picture, board directed down toward management, and the board should figure out what the vision is for the bank for the next 10 years to make sure we're on the same page, and then kind of how we can allocate our financial and managerial resources going forward for the next 3 or 4 years. And then management will do the operational tactical planning. That's not the board's job. Once the board says, for example, once the board says, we're going to expand geographically, we want 3 branches opened in the next 3 years, then it's handed off to management to do the operational tactical planning, bring that back up to the board of directors. We also have a job to do with corporate governance. One of the presentations in this series of presentations is on corporate governance. I'll refer you to that, but best practices for corporate governance, those of us who are not subject to Sarbanes-Oxley, ought to be implemented and can be done so cheaply. There's 7 or 8 things we can do that make a lot of sense in the area of corporate governance. Dealing with the regulators is also a job for the board of directors. The board needs to be engaged. As I mentioned in the introduction, one of the other parts of this series is dealing with the regulators in uncertain times, so I'll direct you to that. But the board needs to be engaged in dealing with the regulators. One of the things that aggravates the regulators more than anything, besides bad loans, and the snowball effect, which I discussed in that presentation, is the fact that the board, quote, doesn't get it and is not engaged. So we need to be engaged. Merger and acquisitions, it's the board's job to deal with mergers and acquisitions, whether we're buying or selling. Again, another series in this, since this is for directors and senior officers, deals with the obligation of the board and the senior officers in the merger and acquisition context. I'll refer you to that as well. We also have an obligation to create share liquidity. If one of the 4-part harmony is, grow earnings, have decent return on equity, the third one was let's create share liquidity. The ability of a shareholder to sell a share of stock at a fair price at the time they want to. That's a question for the board of, do we allocate capital to do that? Now in this scarce capital environment, a lot of the banks who normally would say, yes, we're going to make a market for our stock, we're going to allocate liquidity, are kind of hoarding, and we're going to allocate capital for liquidity, are kind of hoarding that capital because they're uncertain of what the next exam is going to be. They're somewhat of a hunker down strategy. But big picture, long term, one of our jobs is to figure out how we allocate liquidity for those shareholders. We've also got to figure out what we do with respect to allocating capital, if at all, for return to the shareholders by way of dividend. Again, with a lot of banks now in a hunker down strategy, a lot of them are pulling back on that dividend or really struggling with, do we continue to put that money out knowing that we may have to go raise some? But still, our job as directors is to figure out on the fourth piece of that enhancing shareholder value, how do we allocate capital for the dividends? And certainly last but not least involves, is employee ownership a good thing? When we set up our compensation committee who determines what levels of cash compensation, incentive compensation, et cetera, we should be at, one piece they need to determine deals with employee ownership. Does it make sense for us to set up an employee stock ownership plan, restricted stock options, and the like? So all those are more specific legal duties that we need to address. One issue we have once we understand our duties, and a question I get often having sued bank directors in my younger days, is where is our biggest risk of liability? Where can they get in my pocket as a director? I will say, as a premise to this, that I mentioned in the introduction, I did serve as a bank director on a community bank board for 5 years. So obviously, even though I got some calls from some of my friends that said, gee, Jeff, we're sorry we hadn't heard about your lobotomy. What are you, crazy? My reaction was, the risk is manageable. So let's talk a little bit about where that risk comes from now. We've got risk from our shareholders, okay? Shareholders could sue us at any time, holding company if we have one, or a bank if we don't. They could sue us at any time for whatever they want to. Typically it would be garden variety negligence. Good news is that is covered by the typical D&O insurance policy, which I'll mention here in a minute. We could have our bank closed. As of this presentation, there have been 77 bank closings in 2009 in the United States. There would be a lot more if the FDIC had the financial and managerial resources to close them. So we'll have more. The likelihood of your bank closing, as you listen to this, I would suggest is probably minimal. So that's not really a normal risk for a director. So what's our real risk here? I would suggest to you that our real risk as directors is to the regulators for civil money penalties. A civil money penalty can be brought against any what's called an institution affiliated party, director, officer, outside consultant, lawyer, etc., for any violation of law, rule, or regulation. So if you have a consistent violation of Reg O, a repetitive violation of the legal lending limit, a violation of a cease and desist order which has become final, or a formal agreement which has become final, or a written agreement with the Fed, any of those can be the basis for civil money penalty proceedings. Now, as I mentioned in the regulatory presentation, the government just can't come along and tell you have to pay us a penalty. You do have due process rights, but the reality is that, in my opinion, is the biggest risk that we as directors have, is to the regulators for civil money penalties. The rest of the risks, and even that one in my opinion, are manageable. Mainly because, particularly the risk to your shareholders, is subject to what we call the business judgment rule. And that is what I always say is the right to be wrong. To give you an example here, say we do an acquisition transaction and we did everything we could. We made the decision to do it. We relied on experts. We acted in good faith. We didn't have a conflict. We made the decision to do the acquisition. A year later, we find a fraud that had been in there that we just didn't detect. By definition, it was a fraud, and the shareholders sue us. Our reaction when the shareholders sue and said, you never should have done that deal, would be, you're right, we sure as heck wish that we hadn't done that deal, but we have the right to be wrong. We did everything we could, acted in good faith without a disabling conflict, we relied on experts, and we're as sorry as you are this didn't go as well as we thought, but we're not responsible. We're not the insurers of the bank's success. We're not the guarantors of its success. So the business judgment rule, the right to be wrong, provides a great protection for us as directors. I mentioned I think the risk is manageable. That's why I went on a board. As long as you understand the industry, you pay attention to your bank, and then you have the question of, can we rely on management? Now, one question I get often, and I got when I was suing bank directors, that was a little opposite, is, hey, I as a bank director of this failed bank relied on the senior lender to make the loans. I'm not a lender. I didn't make any loans, et cetera, so how can you sue me for all these loans that went bad? The question when you rely on management is that reliance reasonable? And so I'll give you an example. When I was suing bank directors, I would pull them all in a conference room and sit down and tell them I was going to sue them. Let's talk about how much they're going to pay me. And invariably, one of those outside directors would say what I just indicated. We didn't make any loans. You can't sue us. And so I would show them the exam report that came into the bank 2 or 3 years before it failed, ask him if he'd read it, show him that he had signed for it, etc. So he had to acknowledge he'd read it. And in the report, it invariably would say, your chief lender, whoever it is an idiot. Okay? He couldn't make a loan secured by cash if he had to. And so the bottom line was, when that happened, if the directors didn't do anything to fix it, then they lost their right to rely on the management team as a defense to directors' liability. So the story there is that when you get an outside report from the examiners, from your outside auditors, from your outside loan review, make sure you take action on it. Same with the reliance on experts. If the reliance is reasonable, it's a good defense. Well, what else can we do to protect ourselves? There's charter and bylaw provisions. You might check your state law to make sure that you have the broadest indemnification that you can get under state law. Get D&O insurance, and most importantly, in my opinion, get civil money penalty insurance. And the civil money penalty insurance situation, or the use of D&O insurance for civil money penalties, is complicated. It's governed basically by what's called Part 359 of the FDIC rules for all banks. And if you want a memo on that, email me, jgarish@garish.com, and I'll send it to you. But the bottom line is, if you're going to get civil money penalty insurance, you need to pay for it yourself. So if the insurance comes in, it's a rider to the D&O, get with the agent, how much did this cost to the premium? $1,000, good. There's 10 of us that are going to get it. We each cut our own personal check for $100. We document all that in the bank. And then if civil penalty comes up, the insurance can pay not only the legal fees, but the penalty. So take a look at that. That's your biggest risk exposure where they'll get in your pocket. Well, let me wrap up here with a little bit of director's duties. First of all, in order to perform our duties, we need to understand what those are. We need to get educated, and we need to understand our bank. As it relates to the regulators, as I mentioned, we need to be engaged, use outside experts, have outside loan review if you are big enough to afford it, pay attention to the examination reports, because all those things, even though they're not for you, are there to help you. Don't be afraid to question management, and remember that your primary obligation as we go through exercising our duties is to enhance the value for our shareholders.